Okay, this is Chapter 2, and we're going to continue on looking at various issues related to managerial accounting.
Yes.
So first of all, when you're looking at managerial accounting, when you're looking at the types of businesses, there's service companies, merchandising companies, and manufacturing companies. So service companies, they provide intangible assets, and it's the largest sector in Canada. So a service company could be healthcare, could be your dentist, for example, insurance, banking, consulting, accounting firms. So in a service company, there's no inventory, obviously, for sale to clients. And for most service companies, the salaries and benefits make up the bulk of the costs, around up to 70%. So merchandising companies, they are companies that resell products purchased from suppliers. So you have retailers versus wholesalers. So retailers sell to consumers and wholesalers sell in bulk and to the retailers. So example of a merchandising company is Home Hardware and Old Navy, Walmart. Those types of companies would be merchandising companies. And they have just one inventory account, merchandise. Manufacturing companies, they use labor and other inputs such as plant and equipment to convert raw materials into finished products. So you could be looking at Bombardier in terms of making aircraft, McCain Foods, think about your French fries, Rocky Mountain bicycles, for example. So manufacturing companies can sell their products to wholesalers, retailers, or directly to customers. So for manufacturing companies, which is a lot of what this chapter is going to focus on, there's 3 inventory accounts. So manufacturing companies, their accounts are raw materials, work in process, and finished goods. So raw materials and the term direct materials, they're often used interchangeably, so just so you know that. So raw materials, so that you buy the materials and you move it into work in process. So think about an assembly line. You're making cars, for example, so all the different parts are taken out of inventory and put on the assembly line as the workers are putting these cars together. And then when the item is finished, it moves then from work in process to finished goods. So with inventoriable product costs for a merchandiser, so if you're Home Depot, the only inventoriable cost relates to the actual purchase price that you paid for the product that you're buying to put on the shelf to sell, plus any freight that you have to pay to get the product brought in, and then if you're importing it from outside the country, any import duties or tariffs. So that makes up the purchase price for the items that you're selling. However, it's a bit more complicated if you're into the manufacturing type of business. So here you have 2 main categories of costs. There's direct costs and indirect. So direct costs would be materials, direct materials, and direct labor. The reason why we call them direct is you can trace the materials from your inventory account right into the product that you're making. So if you're making a car, you can trace the steering wheel from the inventory right to the car. Direct labor, you know the number of hours that your employees are working on the various production lines. So you can trace the direct labor. But overhead, these are all of the small general overhead costs that you need to run the plant, but you can't really trace it specifically to each product. So they're called indirect costs. So indirect costs related to manufacturing, it's everything that's not direct. So you have indirect materials, indirect labor, you have depreciation, taxes, utilities, repairs and maintenance, etc. So it's the general costs you need in order to run the manufacturing facility. And a couple of other terms you need to be aware of are prime cost and conversion cost. So we refer to the direct materials and direct labor as prime cost. So conversion costs are the direct labor and manufacturing overhead that's incurred in order to convert the materials into finished goods. So those are the terms prime cost and conversion cost. When you're looking at the income statement for a service company, this is the simplest type of income statement that you will see. All of your costs are period costs, so you have your revenues and then you're just listing all of your expenses to come down to operating income. The statement of a merchandiser, it's a little bit more involved, but not significantly more involved. So here, what you're doing here is you're identifying the cost of the goods that you sold during the year. So to figure that out, you look at your beginning inventory. So at the beginning of the year, you always have some inventory typically left from the previous year that you hadn't sold. So you start January 1st with whatever was left not sold on December 31st, for example. Then you want to track the cost of your purchases, the inventory that you've bought, including the freight and import duties. So what you have here is the beginning inventory, what you started with at the beginning of the period, plus what you purchased during the period to sell. So that gives you your cost of goods available for sale. So then you want to figure out, well, how much did I sell? So you figure that out by counting your ending inventory and subtracting that. So if you had $119,500 available for sale, and you had $13,000 worth left, not sold, at December 31st, that means you must have sold $106,500. And of course, from there you continue the calculations to calculate your operating income. The more, I guess, most complicated of the three types of statements would be for the manufacturer, and that's what we're really going to be focusing on a lot in this chapter. So it's the income statement for a manufacturer that you really need to focus on. The other two are pretty straightforward. They're easy to understand. So we start off again with your beginning finished goods, whatever you had completed from the previous period. Then you need to identify the cost that you incurred during the year with respect to the goods that you actually manufactured. And that's highlighted in red. That's $42,000. In order to come up with that number, there's another whole schedule that I'm going to show you that you have to do to come up with your cost of goods manufactured. That cost is never given to you. You always have to calculate it. So then you're looking at, you started the period with $6,000, you made $42,000 worth, so you have $48,000 available for sale, and the amount that you sold is what you had available for sale less what you had left at the end of the year in finished goods tells you sold $40,000 worth. So I'm going to go to the next schedule, which is the $42,000. So the cost of goods manufactured schedule, again here you are looking, first of all, you look at how much work you had in progress at the beginning of the year. So think about you're making items, they're moving along an assembly line, but everything doesn't get finished exactly at December 31st. So you're always going to have some goods left over. So in that case, you bring them forward to January 1st. So you had work that you had started, but you hadn't completed. So it's work in progress. That's 2,000. Then you want to figure out, well, how much direct materials did I use? So Again, you look at the raw materials you started with at the beginning, more materials that you purchased during the year. So you had $36,000 worth of raw materials available for use. Then you subtract your ending inventory to figure out how much materials you used during the period. So here we see it's $14,000. Direct labor, again, that's just, that'll always be given to you. Direct labor is easy to calculate. Then there's the overhead. So in this situation, the company has a total of $12,000 in overhead. So the three categories, your materials, $14,000, your labor, $19,000, and your overhead of $12,000, that is the manufacturing and cost incurred during the year. So what you're looking at here is you started at the beginning of the year with goods that were partially completed, so work in process of $2,000 at the top. Then you want to look at what manufacturing costs did you incur during the year. So it's $45,000. So your total cost that you have to account for is $47,000. And then we're trying to get to the cost of the goods manufactured, so you subtract your ending inventory. So that tells you the cost of the goods that you made and completed during the year is $42,000. So when you're looking at costs, there's two categories. There's controllable and uncontrollable. So as the name implies, controllable, these are costs that management can change or influence over time. Whereas uncontrollable costs are things that there's nothing you can do about it. For example, property taxes. That's really, it's set by the city, and there's really nothing you can do about that. Another way of looking at cost is to identify costs that are relevant versus those that are irrelevant. And it's important to do these categories because what you want to do is ignore irrelevant costs, because if you're making a business decision, what you want to look at are the costs that differ between alternatives. So if you're looking at option A versus option B, you want to look at what are the different costs of each alternative. Whereas irrelevant costs, these are costs that really don't matter. Could be sunk costs, which means it's money you've already spent, or it could be costs that don't change between the alternatives. So you only want to look at the relevant costs, that those are the costs that are changing. So cost behavior. There's two major categories, fixed cost and variable costs. So fixed costs stay the same over a wide range of activities. And because you're spreading your cost out over a number of the units made, the cost remains the same, but as you increase the number of units you manufacture, the cost per unit comes down. Whereas variable cost, they change in direct proportion to the volume. So the more, say, chairs you make, the more wood you're going to use for your chairs, for example. So the cost per unit stays the same, but the more you make, of course, the more variable costs you're going to incur. So just a visual, for example, with insurance. So if you have a vehicle, the insurance costs don't change with the number of kilometers driven, whereas if you're looking at your gasoline, obviously the more mileage you have on your vehicle, the more kilometers you drive, the more gas you're going to use, and that becomes a variable cost. So with manufacturing, the overhead portion includes both fixed and variable cost. So you have like indirect materials. It could be small nuts and bolts and things like that that you really can't trace directly to each, say, item that you're making. So that's a variable cost. It's indirect. You're not tracing it to the product, but it's a manufacturing overhead cost. While the cost of, say, property tax, insurance, and depreciation, that's fixed, regardless of how many items that you're manufacturing. So all of this is important because you want to think about the implications when you're calculating average costs. So if Bombardier, for example, spends $32.5 million making 50 planes in a year, then this would equate to $650,000 per plane. However, that's not always the best approach to take because your costs could change at different levels of output. So what you would want to do is look at the marginal cost of making one more unit. So the fixed cost for Bombardier, for example, their insurance or whatever, that doesn't change when they make one more plane. So what you want to do is look at the marginal cost, and that's the variable cost. So whenever you're manufacturing something, the variable cost is the more you manufacture, the more labor you're going to use, the more direct materials you're going to use. Okay, so now that we've reviewed the key points for Chapter 2, the next step is to review my demonstration problem. So it's a YouTube video where I explain how to solve some of the key problems for this chapter. And I really encourage you to do that. And then there's a few quick check PowerPoints in the file folder for this chapter, just to confirm your understanding. And then make sure that you do the problems that are listed in the syllabus and check your answers against the solutions. And as I've mentioned before, make sure that you do the problems manually, as in with pencil and paper, because if you just do it using Excel, I do use that for demonstration purposes, but you really will remember it better if you do it manually with your pen and paper. Okay, this concludes Chapter 2.